You checked your bank account this morning, saw that savings balance sitting there, and felt good about yourself, maybe even a little proud. You've been disciplined, you've been responsible, you've been doing exactly what every parent, teacher, and financial article told you to do your entire. And here's the part that nobody is going to warn you about, that money you're so proud of is quietly losing value every single day it sits there. Not because of anything you did wrong, not because the economy is rigged against you, or because you picked the wrong bank, or because you're not making enough money, but because of a silent, invisible force that is working against your savings account around the clock. And most people don't fully understand how brutal it actually is. That force is inflation, and in 2025, it is winning. Now, before you roll your eyes and think you've heard the inflation speech 100 times, stick with me, because what most people get wrong isn't that inflation exists. It's that they don't realize inflation is actively charging them rent just for holding cash. Think about that for a second. You worked hard for that money, you sacrificed things you wanted, you resisted every impulse buy and every tempting checkout screen, and the reward for all that discipline is a savings balance that buys less today than it did 12 months ago. That is not a personal finance problem. That is a structural trap that the entire middle class has walked into, and most people won't figure it out until it's already cost them years of real wealth. Here's the number that should make your stomach drop. Since 2021, the United States has averaged over 4% annual inflation. That means the purchasing power of every dollar you own has been shrinking at roughly 4 cents per year, and in some years, significantly faster than that. Now, here's where it gets personal. The average traditional savings account in America right now is paying somewhere around 0.46% interest. So if you have $10,000 sitting in a regular savings account, you're earning about $46 in interest over the course of a full year. Meanwhile, inflation is quietly erasing roughly $400 of that money's real-world purchasing power during that same period. You did not lose that money to a bad investment or a risky decision. You lost it by doing absolutely nothing, by playing it safe, by following the rules, by being responsible. I want you to picture something for a second, because this analogy is going to make this crystal clear. Imagine your savings account is a bucket. Every month, you're faithfully pouring water into that bucket, $100 here, $200 there, doing your part, staying consistent, but there's a hole in the bottom of the bucket. And that hole inflation is draining water out faster than your interest rate is putting it back in. It doesn't matter how disciplined you are about filling the bucket if the leak is bigger than what you're adding. The bucket is still getting emptier in real terms, even as the number on your screen goes up. That disconnect between the number going up and your actual purchasing power going down is exactly why so many people feel like they're doing everything right and still falling behind, because the Now, here's the part where I want to be really clear, because I am not telling you to stop saving money. Saving money is not the problem. The problem is where you are saving it. A traditional savings account made total sense in a world where inflation was stable at 2% and interest rates were competitive. That world no longer exists. And if you're still using the same financial tools your parents used in a completely different economic environment, you are going to get the same results they got, except the math is worse now. The first thing you need to understand is that not all savings accounts are equal, and in 2025, the gap between the worst and the best is enormous. A high-yield savings account, the kind offered by most online banks, is currently paying between 4% and 5% annually. That is not a trick, that is not a gimmick, and it is not complicated to set up. The money is still FDIC insured, it's still accessible, it still functions exactly like a savings account, it just actually keeps pace with inflation instead of surrendering to it. If you have money sitting in a traditional savings account right now, moving it to a high-yield account is the single most impactful zero-risk financial move you can make this week. Not next month. This week. But here's where I need you to shift your thinking entirely, because a high-yield savings account is not a wealth-building tool. It is a wealth preservation tool. There is a massive difference between those two things, and confusing them is what keeps most people financially stagnant for decades. Preservation keeps you from losing ground. Building is what actually closes the gap between where you are and where you want to be. And to build real wealth, the kind that compounds, the kind that eventually starts working harder than you do, you need your money in assets that historically outpace inflation by a significant margin. Think about this. The S&P 500 has returned an average of roughly 10% per year over the last 50 years. Even after accounting for inflation, that's a real return of around 6 to 7% annually. Now, compare that to the 0.46% your traditional savings account is paying you. The difference between those two numbers, compounded over 20 or 30 years, is not a rounding error. It is the difference between retiring comfortably and working until your body forces you to stop. On $10,000 invested at 10% annually for 30 years, you end up with over $174,000. On that same $10,000 sitting in a traditional savings account at 0.46%, you end up with just under $11,500. Same starting point, same time period, completely different outcome, and the only variable is where the money was sitting. Now I know what some of you are thinking. But investing is risky, and I can't afford to lose money. And look, that fear is completely valid. I'm not going to dismiss it. But here's the reframe that changed how I think about this. Not investing is also a risk. It is just a risk that doesn't feel like a risk because the loss happens slowly and invisibly instead of showing up as a red number on a screen. The stock market going down 20% in a bad year feels terrifying. Your savings account quietly eroding 4% of its purchasing power every year for a decade barely registers emotionally, but the math says it should. Risk is not just about volatility. Risk is about the probability that you will not have enough money to live the life you want. And right now, keeping everything in cash is one of the highest risk financial strategies available to you. So here is the simple 3-tier framework that changes everything. Tier 1 is your emergency fund, 3 to 6 months of living expenses, sitting in a high-yield savings account where it earns 4 to 5% and is accessible within a day or two if you need it. This is your financial foundation, your safety net, your walking away money, and it should be the first thing you build before anything else. Tier 2 is your short to medium term savings money you'll need in the next 1 to 5 years, whether that's a house down payment, a car, a wedding, or starting a business. For this tier, look at treasury bills or I-bonds, which in recent years have offered returns that actually keep pace with or beat inflation with essentially zero risk. Tier 3 is your long-term wealth engine money you don't plan to touch for 5 years or more, invested in low-cost index funds that track the broad market. This is where the real compounding